Welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Andrew Palmer. Andrew is the business affairs editor of The Economist, with responsibility for the business, finance, and science sections of the newspaper. He's been with The Economist Group since 1996, and today we're going to be talking to him about his new book, Smart Money, how high-stakes financial innovation is reshaping our world for the better. Andrew has been covering finance for a long time. Let's ask him 5 good questions. All right, welcome back to the show, everybody. My guest today is Andrew Palmer, author of Smart Money. Hey, Andrew, thanks for coming on the show today.
Thanks for having me, Jake. Good to be here.
All right, we got 5 good questions for you. So number 1, what is it about innovation mixed with humanity that often seems to lead to calamity?
Great question. And the book that I've written is specifically about finance. And lots of people will have the financial calamity that happened in 2008 in mind when they hear that question being asked. So, I'm an optimist. I believe that innovation is important, that we have really big problems to solve, and that finance can help us to solve them. But it's undoubtedly the case that good ideas have a habit of turning bad in finance. And I think the reasons for that are partly down to obvious things like greed taking over and one sells as much as one possibly can, and the infrastructure doesn't keep up and standards slip. But there's something more interesting that happens too, which is that finance sort of builds ideas up by standardizing. It enables lots of people to come together quickly, and buyers and sellers can then interact. But that process of standardizing means that people don't do their own research, they don't do due diligence, they start to rely on rules of thumb, credit ratings in the famous example of mortgage-backed securities leading up to the bust. But that's not the only one. FICO scores too were a big part of that. So you have lots of people coalescing around a good idea, and that idea growing fast. New people being drawn into a market and relying on the judgments of others, like those credit rating agencies. And suddenly you have a larger market, less research being done, an assumption that things will work and that safety is a big part of an idea, that things can't unravel. And suddenly trouble hits. And when trouble hits, and you haven't been expecting it, then a panic ensues, and finance is terribly badly equipped for dealing with a panic. So that's a sort of crude schematic for why I think innovation tends to lead to very bad outcomes over the long term. It grows, it draws in amateurs, and those amateurs get a nasty shock at some point, and then they panic.
Yeah, and it seems like I've read before that the innovation follows this path where it will tend to kind of explode, and then it'll blow up in everybody's face, and then when everyone's a little bit disillusioned, then it actually starts to lay more groundwork and then become a more self-sustaining level. And I think that's probably what we've seen with financial as well, where there's these punctuated problems, but then once they have cleared out, it's back to kind of business as usual, and usually the world's better off because of it.
I think that's probably right. I mean, so securitization, for example, a technique that kind of certainly in Europe, and I think for a while in the States, was seen as shorthand for blowing up the world economy. Very useful financial technique, and it's sort of revived in the States, hasn't done so particularly in Europe, but you can see that mechanism of sort of smooshing together lots of income-producing products into a single security. That's been around since the 18th century in France. It's got a lot of good aspects to it, but it just went crazy around the sort of quality of underwriting and the lead up to the financial crisis. So, well done. It's an incredibly useful technique, and in fact, in Europe, which is where I'm speaking to you from, we have a system which is highly dependent on the banks, doesn't rely on capital markets. Those banks are stuffed full of bad loans. They are being regulated very heavily, rightly so, but they're being regulated very heavily. And we have, as a result, a real credit provision problem. And securitization is part of the answer. So done well, it's a very good technique. And I think you're right. You can see that pattern. The blow-ups tend to leave behind a landscape which is a bit more sensible.
Yeah. That's a good segment. Question number 2. A fair number of our audience have, I would say, libertarian sympathies. You discussed in your book something that I'd never heard of before, but I was really intrigued by it. It's this. It's a social impact bond. Why should I be excited about that potentially?
So I think you should be excited about social impact bonds wherever you are on the political spectrum. They speak to both right and left wingers. So the social impact bond is something that tries to fund discretionary public spending, but to introduce the discipline of the market. So the first one ever was done here in England, and it was a prisoner rehabilitation scheme in a city called Peterborough. And the idea is that private money comes in to fund this scheme. So in the Peterborough example, it was a small amount for the first one, £5 million. It's about sort of $8 million, something like that. Was raised from private investors. It funded a rehabilitation scheme for a 5-year period that basically worked intensively with people who were coming out of short prison sentences from a prison in this city, worked to train them in construction, got them accommodation on night one so they didn't reoffend in order to find shelter. And the idea of the bond is that if it works, and the way they measure that is to see the outcomes for this group of prisoners and measure it against a control group, a national control group. If it works, then that should represent a saving to the public purse. The fewer people who reoffend and go back into prison, that is less money spent by the prison system. It's a net saving to the public purse. And that net saving then goes back to pay the original investors with a return. So what it does, it means that the state doesn't have to stump up unless the outcome is good. It means that money is available from private investors over a long period of time, and a longer period than often the public purse provides for, so that social organizations, in this case around the prison, can plan for longer. And it means that there's the possibility of a return to private investors on top. And it's an idea which is very neat, very simple, applies the market to the principles of the market and the discipline of the market to public spending. And it's spreading very fast. So the first one was set up in 2010 here. There are now well over 100 of these social impact bonds either underway or being planned around the world. Almost inevitably, if they do work, the States is where you'll see them sort of at scale. And there are examples in the US too, in Massachusetts in particular, but around the country. I think it's a great idea and one to watch.
Yeah, I mean, I'd really like the idea of getting some more entrepreneurialism introduced into that equation of typically a bureaucratic and hardly any new ideas seeping in type of structure. So I really like that idea.
Yeah, so there's a great study that was done of public spending in the States. There are two problems with public spending. One is, there's fiscal pressure, right? So there's less money around. The second is that the spending that tends to get done by public services, it's not all bad by any means, but a lot of it is not very disciplined. So out of 10 federal spending programs in the US that Brookings looked at, and they used this randomized controlled trial to look at the outcomes that they delivered, 9 out of 10 had no or adverse effects. So it was money completely wasted. And my favorite was one called Scared Straight. So this was a program that took juvenile offenders, put them together with hardcore offenders with the idea of, well, you can guess, scaring them straight. Unsurprisingly, it did not work. It was a complete disaster. It ended up in higher levels of offending.
Turned into criminal protege and mentor.
Exactly right. All paid for by the government. So there's a lot of ineffective spending done there, and I think that the promise of the social impact bond is that people will think much more carefully about how things are designed and what the outcomes are and how you measure those outcomes. Because private capital is being put to work right up front.
Yeah, that accountability is huge.
Yeah.
So question number 3. In your book, you discuss the most dangerous asset in the world. What is that asset and what makes it so dangerous?
Okay, so this is a personal bugbear of mine, Jake, so bear with me. So the most dangerous asset in the world is property. The most dangerous financial instrument in the world is the mortgage, I would contend. I think history would back me up, not just recent history, but if you look at banking crises throughout throughout the past 2 centuries. The really big ones have been caused by property crises. And that's because there are all sorts of terrible characteristics swirling around this asset. One is that it's huge, so if it goes wrong, it's going to bring down banking systems and economies. The second is it relies very heavily on debt. And when debt goes bad and you have to pay things off very, very quickly, you get these spirals that can lead to institutions in trouble. Another is that you have people like, well, you're a professional, I'm not, but you have people like me in there making decisions about how much debt to take on and what to spend. So there are lots of sort of, residential purchase decisions are not necessarily the most thought through.
Sure.
You don't have a way to hedge the market effectively, so banks can't protect themselves very well. And regulators regard it, and bankers themselves regard it as really safe because it's an asset. It's something that, if a loan goes bad,
it's tangible. Yeah,
it's tangible, right? It's security. So if a mortgage goes sour, the bank gets hold of the house, and for that reason, and for that rather good reason, the regulators sort of rig the rules on capital, the amount of money the banks have to hold against unexpected losses. They rig the rules to privilege property. They say this is safer. And guess what? Banks flow towards property as a result. It's the one that they are incentivized to lend against. And, it's when you've got a boom going on, you've got that last little bit of capital to attach to something, it'll always glom onto to property. That's always the place where you'll find it. And I don't think we've learned that lesson. Amazingly, even after 2008, the rules, there's still a chance they're going to get changed, but the rules at the moment still say, lend against property, not to support small businesses. And we know that has bad outcomes, and we also know that it's not very productive beyond a certain scale. It's not particularly helpful for economies.
Yeah, it's definitely still in the U.S. incentivized in the. I often wonder how many people make a decision based on their mortgage interest expense that they're going to be able to write off on their taxes.
Right.
And it's like, okay, maybe that's not the best thing you should be optimizing for.
No, exactly. And it's a really good point. We in the UK got rid of mortgage interest relief about 15 years ago, but it is still kind of, we just had an election here this year, and the one thing you could be guaranteed to hear from politicians on all sides was the need to get first-time buyers into housing and the dream of property ownership, et cetera, et cetera. The States is even worse as far as I can see. The policy settings are still set to shovel people into housing if you possibly can. And that infrastructure, despite lots of talk of reforming Fannie Mae and Freddie Mac, et cetera, that infrastructure remains pretty robust.
Yeah, that's amazing. All right, so question number 4. Everyone likes to badmouth finance for potentially blowing up the world in 2008 or various stages, but 2008 being the last one. What is it about? How is it that financial technology is actually going to impact the lives of the lower strata of humanity, the people who are living on these very, very small amounts of money? That's, I think, maybe the most exciting thing to me that I see in the financial technology sphere. You talk about it in your book, so.
Yeah, I think it's an incredibly good point, and it plays a little bit into what we were just talking about. We came off this big crisis. We're concerned to make things as safe as we possibly can in the way we regulate finance, and one of the ways we do that is to change the capital rules. So you still go for secured lending. That's the property argument. You get banks to hold more capital, et cetera, et cetera. What that does is marginalize the less creditworthy borrower. Now you might think that's good. Subprime, those were the less creditworthy borrowers. We don't want them to have credit shoveled at them. And beyond a certain point, that's clearly true. But there are people who, don't have particularly good credit histories, but can be lent to and will use that money productively. And the promise of some bits of fintech or these new financial technology firms is to use data in new ways to provide credit to people who are on the edges of society. So, there are firms like On Deck Capital, which went public late last year, and others which are using big data to scour people's online profiles, or when they're lending to companies to look at Yelp reviews of restaurants, et cetera, to build up a much more richer, real-time picture of people's creditworthiness than you would do through standard FICO scores or people going into bank branches, where they will undoubtedly just get turned away. So that's incredibly promising way, and a better way, I think, than the standard sort of credit underwriting processes of getting people on the margins of society into banking and into the financial system. And it's one that where in many ways one's learning lessons from developing markets, where microfinance and some of those processes you can see them sort of seeping back into the rich world in really interesting ways.
Yeah. And as kind of a follow-on to that question, the how can this as financial technology help to resolve some of the rising costs of college? Because that's another one that's definitely been a huge concern for a lot of people. I mean, I've seen studies of upwards of $1 trillion of debt for U.S. students in college. I mean, it's a pretty key issue for a lot of people.
It is, and a big issue in the presidential campaign that's slowly unfolding over in the States. And what's happened now is that the idea of student debt is that it's worth it because there's a payoff. Your earnings go up. That's still true in general, but now suddenly things have flipped. So students who graduate with student debt are having to pay more when they buy cars or on mortgages. So it's weighing on graduates in a way that it oughtn't to, if you believe that their creditworthiness over time goes up. And as you say, huge amount of outstanding debt, 1.2 trillion, I think it is now. So one way in which financial technology can help here is to bring together investors in students and potential students. With those students on platforms. So I think we're quite familiar now with the idea of marketplace lenders or peer-to-peer lenders, like Lending Club, where if I have capital and you want to borrow, we can meet on this web platform, and I can funnel credit to you. Well, you can apply that to students too. So there are organizations like Common Bond, which is a startup in New York, which basically identifies very creditworthy graduates and gets investors to fund them at a lower rate of interest than they would do if they were just going through the government sources of financing. Equally, you can imagine, and this is a slow-burning idea, but I think it is a really good one. You can imagine investors in the equity of students, so not providers of debt, using these platforms to identify people to fund. And the idea there is that I would give student X, let's call him Jake. I'd give him a certain amount of money to get through college, and in return, Jake would give me a percentage of his future earnings. So it's not a sort of fixed obligation in the way that debt is, but let's say it's 5% of whatever you earn over a period of time. And that again sort of injects the discipline of the market. I will be interested in kind of what you're studying, what your earnings profile looks like in future. I am not just handing over money as the government currently does without caring about those things. And our interests should be aligned.
Right.
Both of us want you to earn a lot of money.
Yeah, no, I've seen that before, and I thought it was a really interesting idea. One of the reasons I haven't explored it more was that when I saw that there were, I think this was with Pave.com was one of them, but there was a cap on the upper end of how much you could earn per year. And I felt like, okay, most of my return would have been coming from this like few outliers who did. It's almost more like a venture capital model, right, where you have a few, we'll call them unicorns, that are going to make up all of your returns. And when you have that constraint like that, you're pretty much guaranteeing you're not going to do particularly well on it.
That's totally fair. And what's interesting is they're working through these sort of issues around, so if you don't cap, are you going to therefore scare off the potentially really high earners, right? If you're Mark Zuckerberg,
Yeah.
and you really bet on your own ability, you're going to go for debt. It's just you know exactly what you're going to pay. There's no chance of giving away billions. So those caps are ways of trying to navigate that problem, encouraging in potentially high earners rather than scaring them off to debt. So but it's, these are early days. There are some experiments. It's really hard for these platforms to play in equity when there's a huge and proven and familiar debt market. So Pave started off in equity financing and then moved to debt. Mm-hmm. It's easier to make money that way for those providers. But I think there is something there. It's an interesting idea.
Yeah. So question number 5. We haven't heard a lot about it in the last, few months or so, but for a while there, Bitcoin was this kind of all the rage. You were hearing about it everywhere. Everybody wanted to know about it. What are your general thoughts on cryptocurrencies in general, and maybe even more broader, like blockchain technology?
So I think the blockchain matters more than Bitcoin. Bitcoin is obviously interesting. It's got traction. I still struggle to see how it's going to sort of take over in any really meaningful way without the backing of a central bank, without sort of questions about lenders of last resort being resolved. Ultimately, you need some kind of, I think, this might be my judgment. We're in a world where financial crises happen periodically. You need some kind of backstop, which is an issuing agency like a government. But what underlies Bitcoin, this blockchain technology, the ledger that records all the transactions that cannot be sort of fiddled with or appropriated by fraudsters, and is very decentralized, is really, really interesting. We saw through the build up to the crisis all sorts of ways in which the sort of infrastructure of finance didn't work. You had kind of derivatives contracts where the price sort of started to move, but margin wasn't being paid out. So could you automate that? Could you make that programmable as part of the blockchain? That's an interesting area.
Yeah, the MERS process with all the
exactly,
titles.
Right? So, titles is a complete disaster. By the time things got to court, most of those people had no idea who actually owned the securities. It just couldn't keep up with the churning of securities. So something that worked, that was could be authenticated, is very attractive. So there's something there, and clearly there are lots of people who are very, very interested, and there's lots of VC money flowing towards it. At the same time, lots of open questions about how you incentivize people to kind of do the mining that actually authenticates transactions. Does it have to be done with Bitcoin? Can you create private chains? And if you create private chains, do you need to go to the whole hassle of blockchain? Isn't there a sort of simpler way of solving the problems that it claims to? So I think it's incredibly interesting. Definitely one to watch.
Yeah. So bonus question that we always ask every author that comes on.
Yeah.
This is a book recommendation, something that you either feel like is underrated or potentially that has just not gotten its day in the sunshine like you think it should. What do you have for us today?
Okay, so I've gone totally off this topic. It's not finance.
That's encouraged. So
it's non-fiction. So I don't know. You tell me whether you've heard of this guy or whether he has any profile in the States. So he's a Georgian author who writes under the pen name, and Georgia the country, not the state, I should say, who writes under the pen name Boris Akunin. And he's written a series of, I think it's 13 now, detective novels, which are set in 19th century Russia. And they feature a kind of gentleman aristocrat, Sherlock Holmesian detective by the name of Erest Fandorin. Erest Fandorin is his name. And he combines sort of Holmes's brilliant deductive skills with a nice line in martial arts. And it's just wonderfully readable stuff. Sort of very well plotted, sort of comedy. It's a sort of pastiche of different types of literature. But anyway, it's the kind of thing where you pick up the book, it will be read within a day.
You're ready for the next one.
You're ready for the next one, and they're massively, massively popular in Russia. Have a sort of cultish following in the West, and I would highly recommend them.
Oh, that's great. Yeah, that's definitely outside the beaten path. So that's exactly what we're looking for.
Great.
Well, Andrew, we really appreciate you coming on the show today.
Thanks, Jake. Well, thanks for having me. I enjoyed it.
Very interesting conversation.
Thank you.
All right, thanks.